Okay, there we go. Sorry for the false start, everybody. Had a few settings that I forgot to change over. It was just gonna be easier if I just reset the stream rather than try to change it from within. Either way, we are up and running now. Just let me share the appropriate locations real quick. Okay, and we can get started. Okay, so today we're going to be taking a look at ticker NICMF, company Nickel Mines Limited, relatively small Australian nickel ore player. The business is a little bit of a complex mixture of things. They're currently doing some actual mining of nickel right now, but they're also doing a refining process with the RKEF process, working on pig iron. So they have a little bit of a discrepancy of where the business will be headed in the future relative to where it is right now, which we'll have to take into account if we do ever start a position in them and it moves forward in the futures, that our valuation with them will have to change over time as their segmentation changes. But as of the moment, it's fine as it is. As far as the business segmentation goes, it all falls under metals and mining at the end of the day, so it doesn't really make a huge difference, but it is what it is. So I already did all the pre-work for this. Again, entire segmentation based off metals and mining, so we have an unlevered beta of 1.25, sales capital ratio expectations of 0.97, and an expected net margin expectations of 11.07%. We did their debt. They have very little debt, only about $45 million in debt, no lease contracts that I can find, with a weighted average interest rate of about 8.5%. It could go higher if LIBOR rates were to go up, but at the current level it's sitting steady at 8.5%, with an implied duration, because it is a credit facility, but the implied duration of it is about 4 years relative to the expected rollover time frame that their contract requires of them. So it is a penny stock, 68 cents per share, a little tiny thing. The market cap is actually 1.7 billion. That is in wait, never mind, that is in USD. Never mind, I keep double questioning myself on this one. It is an Australian miner. They're incorporated in Australia, but they do their cash flows in USD, and the ticker NICMF is the American ticker for it, so that is also in USD as well. So we don't actually have to do any particular conversions for them. Being such a small uncovered company with they don't have much analyst coverage to speak of, we don't have calls to listen to for them, unfortunately, so I'm just gonna have this music playing in the background while I work. It is probably going to be a relatively short stream because there isn't very many years to work with. We only have these years right here specifically to work with: 2020, 2019, 2018, 2017. Do we have the 16 year? I thought we only had through 2017. Now I'm double questioning myself. Hold on. Yeah, okay, I think it is 5 years. But either way, we only have 5 years of data to look at, so it is relatively limited. Being that they are a nickel miner, we are using our commodity pricing system to come up with revenues. We have correlated the price of nickel against the price of the stock. Now, for most of the times when I do this, I usually use a yearly price with the yearly revenues versus whatever the price of the stock and the commodity is on that yearly point. But since there's so few years to work with this one, I made a little bit of an exception to try to make sure that I could still use this, have this information usable. I actually used the monthly price information right here. You can see the monthly price of NICMF along with the monthly price of nickel. They're actually 31% correlated, and based off of the current price of nickel, we would expect the price of the stock to be 67 cents per share. They are 68 cents per share right now, so that does seem to be pretty good, pretty pretty accurate as far as those correlations go. So I do have a whole lot of years worth of nickel data down here. These are the yearly information going back to 2006, but I did separate it out from the monthly information. So the monthly information is used to correlate against the price of nickel. So I'm using the yearly information to be able to still find out what the quartiles are for each of those sections. So you can see for those years right there, we have quartile levels of the price that we can use for our outcomes. And then we also mix that with the outcomes that we get for nickel after pricing it against, here, I'll go look at it. Nickel. After pricing it against the money supply, which is how we price commodities on their face, generally speaking. So over the time frame of data that we have, nickel and the money supply have approximately a 34% correlation, and as a result of the output, we would expect nickel in 5 years to be possibly about 30,000, which would give them an 8.8% return per year just for the commodity of nickel by itself. So as a result of that, we do end up with a varied set of projected price outcomes of anywhere from a high of 41,000 to a low of 20,000, again, versus the current price of about 19,000. So anywhere from no real gain to real significant gains. So using that information along with the quartiles of past information, so projected future prices along with quartiles of past prices, we use those to come up with a range of input nickel prices anywhere from 10,000, which is half as much as it currently is, up to 30,000, which is 50% higher than the current level, and varied in between. We also have an analyst expected price of about 20,000. Now I actually combined together several sources of analyst prices, 5 different sources altogether, and then just averaged them all together to sort of get a broad base idea of what analyst price projections actually are, because I was getting numbers as high as like 27 or 28,000, as low as like 17,000 or something like that. So I just averaged them all together as all the ones I could find, and that gave me 20,520. So that's going to be our 6th input right there, which incidentally puts it right in the middle, which I'm pretty pleased with that. On a distributed basis, that gets us an expected nickel price of 20,000 or so. Now I had actually already put in the revenue for the most recent year just so I could get the projections off of that. And what that does give us is projections of anywhere from 450 million on the low end to possibly 691 million on the high end, which on a distributed basis, if you take a look at all those outcomes, you end up with a distributed sales growth of about 1.62% per year for the next 5 years. So that's pretty decent. Overall, we're really just kind of assuming the nickel stays steady. That's a fair enough assumption to make, in my opinion. There's a lot of future demand for nickel coming on the backs of the EV revolution, which is part of the reason I'm interested in looking at nickel miners in the first place. But at the same time, a lot of people are rushing in to fill that supply. So prices should be going up, but it should be coming down. There's pressures in both directions. So I think assuming that we stay in this kind of mid-range level with no real major changes I think makes a lot of sense. But that doesn't mean that the revenues don't change that much either. They go up slightly a little bit, but nothing too major, with deviations further up and down depending on the scale of it. So that's basically all the information as far as the commodity goes. We can actually get into the yearly financials now, which, like I said, I only have 5 years of which, and unfortunately I don't have the ability to put them into the spreadsheet like I've been doing with a lot of my other valuations lately. They're only supplying their financial statements in these PDF forms right here, so I can't really copy paste it over very easily. So I do actually have to crunch out all the numbers sort of myself on and just put them in the cells, which it's a little more time consuming. So the fact that that's more time consuming, we only have 5 years to do, works at the end of the day. Maybe it'll sort of balance itself out. So let's go ahead and hop into that. Okay. see. Let me go find the financial statements in all of my reports so I don't have to find them later. Current assets, sales revenue. Okay, then the last one. Current asset sales revenue. Okay, so let's get into it. 523 million for revenues. Increase the size of that so you can see it easier. All right. 321 million in costs of revenues, 201 million net revenues. And they're listing off the depreciation higher up in the line, which is a little bit interesting. And they don't really have SG&A specifically listed. They do have director's fees and consultant expenses along with other expenses. We'll count all those together. 7.4 million. Okay, now financial income. Expenses. Over here real quick. Right, no other expenses. Now income taxes. Non-controlling interest. What's going on here? Okay, there. I'm looking at the wrong line for the profit line. So they're like, what's the problem here? It's correct. Okay, so they don't actually even list their depreciation line on their cash flow statement, which is interesting. We can just transfer it over directly from the income statement if we have to. Also not including working capital changes. They may not really have much in the way of working capital, so that might be fine. Go up here, equate this to that. Put the formula in. Mark it so we know that something's different there. I'll go ahead and put the 0 in here that's going to be required, and then we can do capex as normal. All right, now giving it the share issuance, subtracting out cost of issue and repayment of debt. We end up with a huge amount of cash here, but we do have to net it out, unfortunately. And then dividends. All right, now the balance sheet. Oh, other non-current. One, two, three, four, 6, 7, 6, 94. Okay, cool. Current payables plus tax payables. I'll go ahead and count those together. Deferred taxes. on current liabilities. Okay, so now we got the liabilities all set. Equity. All right, so there's the first year. Only 4 more years to go. All right, second year done. All right, 64 million sales revenue. Now it's worth noting, kind of doing things a little bit roughly here. For this fiscal year 2019, it's actually only a 6-month period because they shifted their fiscal year from ending halfway through the year for these fiscal years, and they only had a 6-month fiscal year right here at the end of 2020, right? And so that the fiscal year 2020 could be a full year in the full year. You can see right here it ends the end of 2020 right here, while this one ends the end of 2019, but this one ends middle of 2019. So that means this period right here is only 6 months, from the middle of 2019 to the end of 2019. Well, this one goes from the middle of 2019 to beginning of 2018. So you can see technically we only have 4.5 years in this period right here, because this column is actually only 6 months, which it's amazing. You'll see how huge of a rapid growth in the revenues that they managed to do during the 6-month period. We're just going to treat it like it's one normal year. That does kind of throw off 3-year averages a little bit, but overall for our valuation, it's not going to have a major impact, because for the most part everything still focuses on whatever the most recent numbers are. We just use the growth of the previous numbers to get an idea about their capital expenditures. So it's like we can make the adjustment for that, but it is worth noting. I just want to make sure that's clear, so that anybody who looks at these numbers themselves isn't like, oh, what he was confused, he had no idea what he was talking about, what he was doing. Like, yeah, no, I'm aware fiscal 2019 is actually a 6-month period, but the only other alternative would have been to take quarterlies and then subtract it out and add back in and try to recreate the full 12-month periods, but I didn't really feel like doing that. And the quarterlies that they put out don't have enough information to make it very useful and doable, so yeah. Either way, that just explains why I'm not doing that. So continuing, we'll have only a few years left to do. Was 1, 1, 2, 8. Slash there. Financing. Ooh, 58 million in financing. Holy crap. My current assets. What am I forgetting? Oh, equity counted method of investees. right. 8% done. Only 2 more to go. Doing pretty good, pretty good. All right, so for 2017, we have a loss of 3.3 million. Moving on to the cash flows. Capital expenditures, about 600,000. Share and debt issuance, 58 million. Net out the share issuance, 73 million. Then to the balance sheet. Down to 26 million in property plant equipment. Tiny, tiny, tiny. No goodwill. All right, there's the assets. Now liabilities, no debt. $3.5 million payables. $500,000 in provisions. No debt. No taxes. Provisions. All right, now the equity capital. All right, and there's that. So one more year. Almost done. So 8.5 million in sales in 2016. Less than $1 million in net revenues. All the bullshit. $4.2 million in bullshit. Appreciation. Almost no interest, income, or expenses, really. $500,000 in expense. Income tax benefit. Non-controlling interest. All right, now capital expenditures. Positions. No, we don't need that. Oops. The issuance. Oh, whoops. All right, now the final balance sheet, and we can call this a day. Oops. right, and that should be the remainder of the assets. All right, and the final equity statement. Okay, cool. So that's it. There's all of the statements that we've got for them. Go take a look. Pay no attention to that. Still got a lot of stuff to do. Take a look. So debt to equity ratio comes up to 2.5%. Very, very tiny amount of debt. So as a result, we're definitely gonna have to adjust the debt to equity ratio because it's currently set to assume that they go to steady state at 45%, which is probably not gonna happen. Thank you for not putting that in a percentage for some reason. If we assume it goes more towards 5 to 10%, God, why is it not? Puts this debt to equity ratio at steady state about 5%, which is closer to what I feel comfortable assuming, because they probably will take on more debt than they currently have, but maybe not a massive amount of debt. They'll stay well leveraged. Either way, they basically no debt. That means the beta stays relatively in line and gives them a levered beta of 1.28% on top of the equity risk premium we're giving them. That gets them to a cost of equity of 10%, and then based off of the book cost of debt and the overall weight of the debt to equity, that gets us to a cost of capital of 9.91%. We perhaps need to adjust for some other factors. It looks like the rolling cost of debt is within range, so there's no problems there. As far as tax rate, it is way too low. It's hard to say if that's how long it's going to stay that way, because it could be that this is going to stay that way because of carry forward losses, but you could also assume that in some sort of steady state it goes up to some higher level. Well, let's assume it's maybe double what its highest rate was part of that, which would be close to 11-12%, which is still a pretty low tax rate, but it's got to be somewhere in a more reasonable range. So we'll just assume that seems to be a better set of assumption to go with. Now moving on to other factors, let's go take a look at their sales to capital ratio. Sales to capital ratio in the last 3 years has averaged about 0.38. Over the 5-year period, it's averaged 0.4. So you could argue that it could go up a little bit higher than that. Also in the most recent years, when they've actually been more profitable, has it's gone up a lot more significantly. So if you use maybe 0.4 as a base and go down to here with 0.75 maybe as a high point, that gets us to a distributed expectations of 0.56, which is lower than the current level, but I think that's perhaps a fair margin. Oh, well, this has to kind of be put in, so maybe 0.5 for the midpoint there. That brings us to 0.48, which is higher than the current average but lower than the current year. So it's, I think, a fair range of assumptions to be putting it in. That brings us to the margin, which is going to have a huge effect on the value, because, well, this is where things get a little bit tricky, because as you can see here, for the last 3 years, they've averaged about a 50% margin, but that partially has to do with the the basically 100% corrected net margin that we have here. So the average is kind of thrown off as a result. If we use the 5-year average, that gets us to 15%, which is much more in line with what we would be expecting. Again, the overall expectations is the sales capital ratio would be less than 1% with net margin closer to 10%. So if we're going to have a much lower sales to capital ratio, you would expect perhaps to have a higher net margin. So getting to 15%, I actually think is pretty decent. Use maybe 7. I don't know why it's confusing to keep the percentage there. 7% is maybe the midpoint there, with maybe 30% on the high end. Other things that still do have to be taken into account, which is, for example, the revenue projections that we used. If we use the revenue projections in basically the same set of assumptions, that gets us to a sales to capital ratio expectations of 0.24 to possibly 0.55, which is higher than my lowest point here. So if we say 0.25, 0.55, it doesn't really improve the value because it doesn't improve the low end, but also lowers the high end of things. So I think it makes more sense to tail the high end further up while also having the low end a little bit lower than that. So I'm actually okay with this set of assumptions. That's just for the sales to capital ratio, and then there's margins to take into account, which gets us anywhere from maybe 8.5% to 25%, which is also a little bit different from where we currently are. Maybe 8.5% to 25%. Still feel better. That gets us to expected returns on invested capital of about 12% compared to the 3-year average of 7.5%, and most recent year it's 14.5%. So I think 12% is not actually that unreasonable once you take the most recent year into account. Overall debt is pretty measly as a result of this, partially because of the low debt to equity ratios, which we might have to adjust. So let's actually take the moment to take that into account. Presumed market cap dropping of 400,000, so maybe about a quarter, so 25% downward in market cap, while perhaps doubling the debt would get to 5%, 6, 7%. So that would actually suggest that this should maybe be like 7% or something. Which we'll go ahead and leave it at 10% because it does them a slight favor in that regard. You could argue that this shouldn't be 0%, perhaps this should be like 1 or 2%. But we'll go ahead and just leave it as is. Hold on, just one moment. All right, I'm back. Sorry, my cat in the room. So either way, I don't think I see too much else that I want to adjust for this. Everything else seems to be about right. Hold on. Okay. Yeah, so I think that's basically gonna do it for this one. I don't see too much else that I'm willing to adjust for them. So ticker NICMF, Nickel Mines Limited, Australian nickel mining company. Today, the U.S. Treasury sale is 1.59%, with equity risk premium of 4.99%. With the adjusting for risk, we get to a discount rate for this company of 10.04%. And they currently have a quarterly dividend that they're paying out, which in the trailing 12-month period is currently 4.34%. In the most recent year, they had sales of $523 million, a sales to capital ratio of 0.38, which is really low relative to the industry expectations of 0.97. Returns on invested capital is 7.52%, and debt to equity ratio extremely low of 2.46%. I'm forgetting to do defaults, as I pretty much always do. Give me a moment. Six, 9, 7, 6. Okay, there we go. All right, sorry about that. So in the most recent year, they basically have almost 0% default risk, profit margins of 15.39%, and that gets them profit of $111 million. They're currently selling for 68 cents per share. And we're using a commodity pricing model, so our probability distribution is even across the board. And with that, the commodity that we're pricing against it is nickel, which we have nickel price expectations 5 years from now of anywhere from 10,500 to possibly up to 30,800, with an expected value of 20,400 per metric ton of nickel in 5 years again. Based off of that commodity pricing, we come up with revenues anywhere from 458 million to 691 million in 5 years. On a distributed basis, that gets us 572 million, which would be 1.62% per year higher for the next 5 years. We have sales to capital ratio expectations of 0.48, which is a little bit higher than the current year, but still lower than their industrial averages overall. And that gets them higher returns on invested capital, pushing it up to 12.13%. And then we're also assuming they take on more debt to achieve this, possibly pushing it up to about 5%, which is still relatively low. So that still gives them a default risk that's extraordinarily low over the 5-year period, where we have a distributed default risk of 0.57% per year. We are also assuming profit margins in the 5-year forward period on a distributed basis of around 18.96%, and that would give them a distributed profit of $114 million. Which, based off the discount rate that we have for them, that gets them a present value of 63 cents per share, which is 7% lower than its current price. On 5-year forward value targets, unadjusted for the dividends that they'd be paying out, we have expectations of the value of anywhere from 46 cents per share to a high end of 165 cents per share, or $1.65 per share. On a distributed basis, that gets us a value target 5 years from now of $1.02 per share, which compared to the current price gets an implied return of 8.42% per year for the next 5 years. The stock is not tracked by analysts, so the short-term pricing metric is not going to be meaningful, since that is part of the inputs required for that. And the value score that I get for them is 0.69, which is not terrible, but also not amazing. It's not a buy level, but it's also not really a sell level. It's relatively close to the index. The index score is about 0.6. So they're still better to hold on an individual stock level relative to the index, but they definitely don't score very high on qualitative measures that would make them a decent buy relative to the returns. So that's going to be it for Nickel Mines Limited. It was pretty interesting. Always fun to do a little tiny company. Always good to do a little penny stock. These companies often have opportunities that are passed up by people because of one reason or another, hard to look at, or just uninteresting, or not a large enough capital base for people to invest in. But I like to take advantage of those opportunities, those little dark sides in the market, to look for opportunities, which is what we were hoping for here. But it turns out it's not really that great of an opportunity, but also not terrible either. We can pay attention to it. If it did decide to drop below its present value, maybe closer to 60 cents, or even if it went closer to 50 cents or lower, it could start to look much more appealing. And considering its sector and its size, I wouldn't be surprised to see such jumps happen regularly. I'm pretty sure I was looking at the other day and I saw it do like a 12% move in one day. So I think that was to the upside, but the point is you can just as easily have a 20% downside in a stock like this. So while it isn't a great opportunity today, it's very easy to imagine it being a buying opportunity in the near future if it was to drop enough. So we'll definitely keep paying attention to it. I'm very interested in nickel as a commodity and would definitely like to have nickel exposure in my portfolio. So we'll keep an eye on this one and maybe take a look at some other nickel miners in the future. So that's going to do it for us today. It was a pretty interesting little company. Unfortunate that it's not a decent buying opportunity, but always fun to look at whether we buy or not. So I will catch you all again on Friday. Still a little uncertain of what I'm going to be doing next. The next one on the list, officially speaking, is SIGA Technologies, an American biotech company. But having looked a little bit further at its business model, I'm a little bit less interested in that one. So we might skip over it and move on to the next one, which I think the next one after that was a gold miner, another Australian company. So maybe we'll do that one. Maybe we'll do SIGA. Maybe we'll do something else. But I'll catch you all again on Friday.